Today, we're diving into one of the most important financial decisions you may ever make: how to take your pension. This is one of those decisions that you really only get one shot at. And once you choose, it's locked in. So, we're going to break down the three main pension payout options: life only, joint life, and the big one many people get excited about, the lump sum. Now, here's the thing: pension packets usually come with a bunch of paperwork, confusing tables and terms you probably haven't used since a college math class. And to make it even trickier, your pension decisions can impact your spouse, your taxes, your long-term income, and even the legacy you leave behind. But don't worry, I'm going to make this simple, clear, and super conversational. We're going to take this step by step using real life stories, everyday examples, and we'll even run some math together so you can see what actually makes sense. By the end of this video, you'll understand how every pension option works, when each one makes sense, and which one might be the smartest move for your situation. So grab a cup of coffee, sit back, and let's talk and walk through this together. All right, let's get into it. First, let's talk about how pensions really work. A pension or defined benefit plan is basically a paycheck your employer guarantees you for your life or your spouse's life after you retire. Unlike a 401k, where you take the investment risk, with a pension, your employer takes on the risk. They manage the money, they invest it, and based on your salary and years of service, they promise you a lifetime income. But when retirement day approaches, they hand you a document with different payout options, each one paying differently depending on things like your age, your spouse's age, your life expectancy, and current interest rates. And honestly, the first time people see these options, they usually panic a little. Now, let me tell you a quick story about Carol. I'll never forget. She worked at her company for 3 years. She came into my office with her pension packet and said, "Vince, I have no idea what any of this means. It might as well be written in ancient Greek." And that's how a lot of people feel. The pension world is filled with actuarial math, mortality tables, discount rate formulas, stuff most humans don't look at day to day. So let's slow it down. There are really just two big things driving the pension payout numbers. One, how long you're expected to live, and two, what interest rates are at the moment you retire. If interest rates are lower, the payout might not be as good. If interest rates are higher, the moment you retire, they might be a little bit better. So if the plan thinks you'll live longer, monthly payments tend to be lower. If interest rates are higher, again, lump sums tend to go down. If rates are low, lump sums tend to go up. Okay, so you've got the basic mechanics. Now let's dig into the options. First, let's talk about the most simple one, life only. Now, the life only option pays you the highest monthly amount. Why? Because it's only covering one life, your life. When you pass away, the payments stop. There's no continuation, no payout to your spouse, no payout to your kids. It's done. This option can be very tempting. Who doesn't want a highest or the higher monthly check? Now, let's say your life only pension is $3,000 a month. Meanwhile, your joint life option might be closer to something like $2,600 or $2,450 a month. That's a $400 or $550 difference every single month. And that difference can cover groceries, travel, or medical insurance. It's not a small amount. Now, I had a client named Jeff. He was never married, no kids, didn't even have a dog. He had one recreational love in life, which was his Harley. When we reviewed his options, the life only paid nearly 20% more than the joint life, and because he didn't have a spouse or any dependents, life only was perfect for him. He got the maximum payout and used that extra income to spend more time at his cabin and take longer bike trips. Now, on the other example, we have Jim and Rebecca. And now, obviously, they are going to be married, and what they originally told me is that they wanted the highest payment, life only. But when I asked what would happen if Jim passed away first, Rebecca said, "What? Wait, I get nothing?" Yep, nothing. Their entire perspective changed instantly. They switched to the joint life because the risk was just too big. So life only can be great, but only if it fits your particular situation. Option 2 is joint and survivor. Now, let's look at the joint and survivor option. This is what most married couples gravitate toward. With joint life, your pension continues and it'll continue paying after you die, usually to your spouse, but the amount depends on the version you choose. You could choose a 50% joint option, which means half the benefit goes to your spouse once you pass away. You could choose 75% joint, so somewhere in the middle, or what most of them pick is 100% joint, where the spouse gets the full amount you were getting regardless if you're no longer living. So here's a simple comparison example. Life only might look like a $3,000 per month. Joint with 50% survivor might look like $2,700 a month, and joint 100% survivorship would look maybe like $2,450 a month. So the most protection you choose for your spouse, the lower your payment, but the higher the security you have between you and your spouse. Now, I worked with a couple named Mark and Elise. Mark had a sizable pension. Elise had stayed home most of their marriage and had a very small Social Security benefit. If Mark passed first, she didn't have income. She'd be in real trouble. For them, joint 100% survivorship was an easy decision. They traded a little income now for a lot more peace of mind later. Now, let me talk about another side of the story. I worked with another couple, Tim and Angela, who both had strong pensions. In this case, if one passed away, the other still had a full pension. They still didn't need to reduce their monthly benefit with a joint survivor option, so they chose life only and maximized the income while they were both able and living while they're still financially safe. Now, see how different personal situations can change this? Joint life is amazing, but only when your household truly needs that protection. Now let's look at the lump sum option. Now, the lump sum option is obviously where they will give you the full amount, but once you make that decision, again, it's permanent. This is where the pension plan says instead of paying you monthly for life, we'll give you the entire present value of your pension right now, and they write a check. Now, you can take that lump sum and roll it into an IRA so that way you don't incur any taxes, and then invest it yourself, and then distribute how you want it. Now, here are a few reasons why people like the lump sum option. 1 is control. You manage the money. 2, flexibility. You decide how much you withdraw. 3, legacy. Unlike life only or the joint life option, there's nothing that goes to your beneficiaries. So this way, it'll leave money left over to your heirs. And there's also number 4, growth potential. Good investments may outperform the pension. But there are risks too, and they are important to weigh. Some of the risks might be markets can drop. You might pick poor investment choices, which could hurt the long-term income. You could run out of money if withdrawals are too high. For example, I had a client named Paul, an engineer, extremely analytical. When he saw his lump sum number, $720,000, he said, "Vince, I can absolutely manage this better than the pension can." And honestly, he could. He was disciplined, patient, and not emotional with his money. But then there was Susan, a teacher. She hated investing. She didn't like taking risk. She didn't want to worry about market swings. For her, the guaranteed monthly check gave her the most peace of mind and stability. So again, lump sum can be amazing, but only if it fits your personality and your risk tolerance. Now, should you take the lump sum? Let's do the math. Let's run a real example because this is what most people want to know. Imagine you're choosing between a $3,000 per month for life or a $550,000 lump sum. Here's the key question. What rate of return do you need to safely withdraw $3,000 a month for the rest of your life off of that $500,000? So let's walk through a few simple scenarios. 1 is looking at a conservative 4% return. At 4% return, withdrawing $3,000 a month from $550,000 means you'd run out of money around age 87 or age 89, or somewhere in between. Not terrible, but cutting it a little close. If you have longevity in your family, that might put a little strain, or you could potentially run out. If we look at scenario B, maybe you have a moderate 6% return. then your money could last close to 25 to 28 years. And that puts just about you on pace with the pension's value. This is typically the break-even point. Now, let's say you have a strong 7 or 8% return. Now we're talking about potentially growing the account and having money left over for your beneficiaries. That's the value of investing, but also the risk, because markets don't move in straight lines. One other way you could look at it is taking the lump sum and putting it into dividends and interest. If you're going to, let's say, get 5% off of that amount of money, you're still looking over $2,000 a month, but then you're not touching the principal, and that way you can still leave the money behind. You're just not going to get as much income. So you have to kind of weigh what makes sense for your particular situation. Do you really need all that income, or can you live on a little bit less and then still leave money behind? I worked with a couple who retired in 2007. Perfect timing, right? Before the 2008 market crash, they had taken the lump sum. Now, within a year, their portfolio dropped 40% because of 2008. They recovered, but it significantly changed how they could withdraw. This is what we call sequence of returns risk. If bad markets happen early in retirement, it hurts more than if they happen later. So, which option is smartest? All right, you've seen the pros and cons, you've heard the stories, you've seen the math. So, which option is smartest for you? The honest answer, there's no universal best option, but there is a best option for you. Here are 5 main factors. 1, your marital status and spousal needs. If your spouse depends on your income, joint life is usually the safest option. If you're single or your spouse has their own pension, life only or a lump sum becomes more appealing. Health and longevity. If you're in poor health, life only gives you more income, and lump sum gives you flexibility. If you're in great health and expect a long life, monthly pension payments become extremely valuable. Number 3 is risk tolerance. Do you like investing? Do you hate it? Can you stay calm in the downturn? Your honest answer matters. Number 4 is the desire to leave money to your beneficiaries. Pensions typically end when you end. Lump sums, so if you take the lump sum from the pension, allows you to leave money behind if you invest it wisely. And then we have interest rates. High rates equals lower lump sums. Lower rates equal higher lump sums. Timing matters more than people realize. So here's the quick framework I like to use with my clients. 1, let's estimate the longevity. Let's look at your health, your family history, your lifestyle. And then step 2, we'll consider your spouse's income needs. Will they be okay if you pass first? Then we'll assess your investment confidence. If investing stresses you out, then a lump sum may not be the best option for you. Then we'll compare break-even returns. If the pension's equivalent to a 5% return, it's usually a stronger offer. Then make sure you get personalized help. Have a retirement planner run your exact numbers. This pension decision truly matters, not just for your income, but for your spouse, your long-term security, and even your legacy. But now you understand the options, you understand the math, you understand how to think it through. If you want help running your specific pension numbers, drop a comment or reach out. I'll have a link in the description below where you can set up a free 15-minute complimentary session with us, and we'll make sure to run your scenarios. Thanks for watching, and I'll see you next time. Oh, and one more thing. If you could do me a favor and make sure to subscribe to the channel, I would really appreciate it. Thank you.